Welcome back to another stock analysis, where I'll look at some key metrics to calculate the fair value and my buy price for the stock. Today I'm going to analyze Waste Management, which is one of the biggest companies in the industrial sector. Last, they generated a revenue of $18 billion and they have a market capitalization of $72 billion. The revenue of Waste Management can be divided into 5 segments, which firstly is collection with 54%. This includes collection of commercial, industrial and residential waste. The next segment is landfill with 19%. Waste Management owned or operated 255 solid waste landfills and 5 secure hazardous waste landfills in 2021. This is the largest network of landfills throughout the US and Canada. Next comes transfer with 10%, where they owned or operated 340 transfer stations in the US and in Canada. Recycling contributes with 8% to the revenue, and in 2021, Waste Management operated 69 so-called material recovery facilities, where cardboard, paper, glass, metals, plastics, and other commodities get recycled. The last 10% comes from the other segment. Waste Management mainly operates in the US, where also 69% of the revenue comes from, and the last 4% comes from Canada. If you want to know more about the revenue, you can check out the annual report of Waste Management, which I have linked down below. Enough about the introduction. Let's find out if Waste Management is a good stock to buy at its current value. The key matrix I use to calculate the fair value and buy price for Waste Management is the dividend yield. I'll start with plotting the dividend yield for the last few years in a historical chart. I choose the dividend yield because a consistent dividend policy for me is the best indicator for a stable company. Additionally, a steady dividend payout helps to stabilize my portfolio and it makes it easier to rebalance my positions. To create some sort of signal line, I take the 5 years moving average of the dividend yield and plot it in the chart. The simple approach is now that the stock seems overvalued when it's under the moving average and undervalued when it's over it. The average of the last 5 years is 1.89%, and I would like to define this as the historical dividend yield. Since the historical yield is the fundament for my fair value and buy price calculation, this value shouldn't be too volatile. In an ideal case, the curve will give a straight line. I can measure how much the curve deviates from this ideal straight line by calculating the relative standard deviation, which for Waste Management is 22.3%. To the historical yield, add a personal defined margin of safety of 25%. This margin of safety will be adjusted upwards or downwards depending on the matrix of the company. My first criteria is the stability of the dividend measured with the relative standard deviation. With this value I can measure how volatile the dividend yield is. A high relative standard deviation would higher my risk to invest at a bad timing. As said earlier, the relative standard deviation for Waste Management is 22.3%. And this value is in the red section of a rating scale, and therefore I'll add 5% to the margin of safety. As a dividend investor, the dividend growth of course is a very important matrix for me. In 2007, 96 cents were paid, and in 2022, $2.53 is expected. Waste Management has paid and increased the dividend for 18 consecutive years, which makes them a dividend contender. And in the last 5 years, the average dividend growth was 8.3%. And this value is in the light green section of a rating scale, and therefore I'll subtract 5% from the margin of safety. By looking at the payout ratio, I'll find out if this dividend growth is sustainable for the company. I always look at the payout ratio in respect to the free cash flow, which is the cash flow the company has available after they've paid all necessary expenses. The free cash flow from Waste Management has increased from $1.9 billion in 2018 to $2.5 billion in 2021. The cash dividend were respectively $0.8 billion and $1 billion. The average payout ratio thereby becomes 39%. This value is in the yellow section of our rating scale, and therefore the margin of safety doesn't change. Before we continue the analysis, I would like to remind you that if you like my stock analysis, you can support the channel by liking the video and subscribe to my channel if you haven't already. If you also would like to support me financially, you can check out the links in the video description, where you can open new portfolios or buy some great investor books. With that being said, you can of course also just continue to watch my videos, which is already a huge support. But now, let's get back to the analysis. Next, I'll take a look at the debt situation. The company has a debt of $13.3 billion and have $0.1 billion in cash. When the cash gets subtracted from the debt, and this value then gets divided by the EBITDA, the debt to equity ratio is found. The EBITDA is currently at $5 billion, which leads to a debt to equity ratio of 262%. This matrix tells us that the company could pay off the whole debt in around 2.5 years if they wanted to. This matrix is once again in the yellow section of a rating scale, and therefore the margin of safety doesn't change. For the business to be sustainable, growth is a very important factor. The revenue has increased from $14.5 billion in 2017 to $17.9 billion in 2021. This gives an average growth of 5.5%. In the same period of time, the EBIT increased from $2.6 billion to $3 billion, which gives an average growth of 3.6%. The margin is then found by dividing the EBIT with the revenue, which in 2017 gives 18.2% and in 2021 decreased to 16.9%. Since the revenue increases at a higher rate than the EBIT, it only makes sense that the profitability of the company decreases. In this case, it decreases with 1.8% in average. An EBIT growth of 3.6% is inside the yellow section of our rating scale, which gives no further adjustment to the margin of safety. For an average margin growth of minus 1.8% on the other hand, I'll add 10% to the margin of safety. The last thing I'm looking at is the potential yield on cost. This matrix tells how great the potential investment in waste management would be and what annual income I could expect in a few years. Waste management has a dividend yield of 1.46% and a dividend growth rate of 8.3%. I assume that the dividend gets fully reinvested at the same conditions. But I'll subtract 15% from every dividend payment because there are 15% withholding taxes for stocks from the US. After 5 years, the yield on cost would be 2.4%, after 10 years it would be 4%, and after 15 years it would be 7.1%. I only calculate the potential yield on cost for the coming 15 years because of the natural uncertainty of this matrix. And yield on cost of 7.1% after 15 years is not that great, and in the red section of our rating scale, and therefore I'll add 5% to the margin of safety. Since every matrix from my analysis has now been collected, it is time to adjust the margin of safety. Plus 5% for the relative standard deviation, minus 5% for the dividend growth, plus 10% for the margin growth, and plus 5% for the potential yield on cost. Thereby, the new margin of safety becomes 40%. This leads to a desired dividend yield of 2.65%. By a current dividend of $2.53, I should therefore don't pay more than $96 for the stock. By ignoring the margin of safety, the fair price of the stock is determined, which for waste management is $134. These values can also be shown graphically in the chart for the historical dividend yield. This is done by adding the margin of safety to the historical yield curve. This then gives a new curve which always lies 40% over the historical yield. As seen in the graph, the yield curve is under the historical yield and the margin of safety curve. Therefore, I consider the stock as overvalued. Finally, I consider the stock at its fair value when the price is $134. I would buy the stock at $96 and the stock price is currently at $173. That's it for today's video and thank you for watching.